the first edition of 18 Minutes Real Estate. And friends, we are bringing to you the same format that we do for all of our 180 Markets interviews, where we interview experts, CEOs, pro investor series, and so forth and so on, except not geared towards markets only, but now geared towards property as well. And with us, I'm very happy to have Chris Broad from TierONE Capital as our inaugural guest. TierONE is a specialist non-bank lender. They specialize especially in the small end of town. And he's going to talk all about it, Chris, is what he's seeing in the markets, why the NBL space has grown so much over the last, call it 3 or 4 years, and what is in store for the future. And obviously, their great track record as well. With that introduction, Chris, welcome to the show.
Thanks, Greg, and great to be with you for the kickoff in the real estate world.
Absolutely. Hey, Chris, we always start out with someone's story, their background. Can you just give us a little bit about your background?
Yeah, sure. So I'm told that no one can tell by my accent anymore, but I grew up in the UK. Started my career with Deloitte and came to Australia in 1995 for about 12 months, and I haven't left yet. So I'm sort of here for the duration, Greg. Great place to live and do business. My experience is all in banking, financial services, professional services. And so I've been with the likes of Citibank, Visa, and the last 5 years I've been with TierONE Capital and businesses associated with it.
Absolutely. And for those of us that are not as familiar with TierONE as they should be, can you just talk a little bit about the business and also about that there's a connection with Charter Hall as well?
Yeah, sure. So TierONE Capital really came about. It's a marriage of a couple of things. One is the market opportunity in non-bank lending, as it's called, and secondly, our business has a lot of experience in loan origination, in writing credit, and also funds management. So what we really did is we brought together the combination of those skills, people, and market opportunity, and formed TierONE Capital as a non-bank lending opportunity to give both our investors a great opportunity to get into a strong proposition around risk and yield. And then secondly, we have a network of relationship with borrowers and with brokers who are seeking funding for development finance. And all of our focus is on property finance. So we work with commercial borrowers and developers. They might be looking to secure land, undertake construction, or finance completed assets at the end of that process. That's really where we fit into the food chain.
Absolutely. And, within there, the non-bank lending space, maybe it's a good time to segue into the non-bank lending market has really grown, exponentially over, call it the last 3 or 4 or 5 years. What in your mind has changed?
Yeah, sure. Look, I think there's a combination of things here. If you look at our own business, we brought together some skills from really 2 groups, one called Oz Finance Group, and that business has focused really since the early 2000s on all things development finance related. The part of the business comes from a company called Leftfield. Leftfield is the family office for a gentleman called Greg Paramore. Greg won't mind saying that he's a veteran of the property funds management industry. So he's been former CEO of Mirvac. He founded a business called Folkestone, which was listed and then subsequently sold to Charter Hall. And Charter Hall is one of the biggest real estate funds management businesses in Australia today. It's grown significantly. So what you really find is that there is a lot of skill set within people who know about commercial lending, but they're appearing in this market outside of the traditional banking world. And that's really where that has come about. We'd also say that there's a strong demand or a strong supply, in fact, of capital wanting to participate in this mortgage lending space. And it's an area which really traditionally has been occupied by the banks. But over the last 5 years in particular, we've really seen the rise of non-bank lenders who are meeting an opportunity in the market that in some ways has been left by the banks and where they haven't been participating over that time.
Yeah, absolutely. And then, when you have such a wide swath as, non-bank lending for property finance, it's almost like you could be spoiled for choice. But in
Yeah.
the case of tier one tends to have a little bit more focus. Can you just describe for the audience what segment of property finance you tend to focus on at tier one?
Sure. I think it's a really important point, because if you're an investor and you're looking for opportunities, you've got a whole range of assets that you can participate in. And ultimately, what you're really looking for is, for that particular asset class that you're investing in, who is the best in breed? Who is going to give me the best opportunity in that space? So for us, the key message, it's all about focus. We tend to work on ticket sizes, so loans of around 2 to 10 million. The duration of those is probably 12 to 15 months maximum. Why we like that is, during that period of time, the next phase of that development cycle should be occurring for those types of loan sizes. So land, for example, goes into construction. Construction goes into a completed property. Completed property gets refinanced by a bank. We see these things moving through a cycle. And for us, that's a really good sign that the loan is sort of beginning, has a middle, and has an end. And everything about lending, there's one key word, there's one key word for today. It's all about exit. When you look at lending, the real key word is how you get out of this at the end of the day. And whenever we look at these opportunities, we work backwards and say, what's the end position and how are we going to get there? So for us, it's probably concentrating more on those smaller end of the market. We think that that's a really good area to play at the moment. And within that, there is still diversity, right? Because you might be looking at something in Brisbane or Sydney or Melbourne. You might be looking at residential, industrial, childcare. So you can focus on that niche that I've described, but still within that, get a diversity of different loan types. And a lot of what our investors see is that they can build up a portfolio of loans within that sort of sub-asset class.
Absolutely. And I suppose also one of the things with specializing is you really do tend to develop an expertise in that niche. And it's certainly not to say that there may be another expertise in long dated land loans, as an example.
Sure.
But you just have to find your spot and where you have edge. Is that a good way of thinking about it too?
I think that's a really good summary. I think what we're seeing is that when there is a lot of capital looking at this property lending space at the moment, it's really about sticking to your knitting and focus, because what you've got to avoid doing is just chasing deals and trying to put money to work without considering what is the appropriate risk premium, right? So at the end of the day, if there's a good deal, money will be attracted to a good deal. But from our point of view, we only want to participate in a loan where we see that the risk return reward is sound, right? And that's a key message to those who invest through us, is we really want to focus on those loans that we see it having the right risk pricing to it. We don't want to just chase things down the yield curve simply because there's a requirement to place funds. Ultimately, we're a loan-driven business, and we attract capital because of the quality of the loans.
Absolutely. And maybe that's a good segue into, can you just spend a couple minutes going through your investment process from a high level, but from start to finish? How do you find a loan? How does it get moved through the tier one, I suppose, research process and, to an exit point?
Sure. And yeah, one of the things to say to start with is, by the time that investors actually get to look at a particular opportunity, a huge amount of work has already been done.
I'm sure.
And that's really a function of a number of things. One is, what's really important, first of all, is that you have access to a wide range and opportunity of loans. So we, within our own team, have folk dedicated to loan origination, i.e. they're out there talking to commercial lending brokers, to borrowers directly, and they're really experts in identifying those loans in the first place. We think that's a bit of a speciality for ourselves, because not all lending businesses they rely very much on third parties, whereas we partner with third parties, but we have our own in-house capability to source those loans. So primarily what we do is we get some key metrics on a loan opportunity, and we'll undertake some kind of prima facie assessment, which sort of gives us a very early read. Is that a yes that we want to continue pursuing, or is it a no, it's not a loan for us? And if it's not a loan for us, it doesn't mean that it's a bad loan. You know, we say there's a home for every loan, but ultimately maybe that's somebody else's. So if it looks like the type of loan that I've described to you before, then we undertake some initial documentation with the borrower, either directly or through the help of a broker if a broker is involved. We're normally setting out an indicative term sheet, and if that's signed, then we've really got the structure of what that deal is going to look like. Attached to that is a whole series of conditions, which we call conditions precedent, and they are things that have to be met before a loan can be settled. Could be everything from pre-sales, undertaking a valuation, getting a quantity surveyor to come out on site and look at the build contract and check that there's adequate funding to complete the deal. The real process is about ensuring that we can get to the end of the loan with adequate funding. We're looking at due diligence around the borrower who we're lending the money to, and then we're looking at the asset. And there are some important steps that I might just touch on at this point. One is that we undertake a process with a professional valuation firm. And so we will always obtain a valuation, and that gives us a sense of what we're going to be able to do as far as how much we'll lend against that valuation. If it's a construction loan, we'll go to a quantity surveyor and get them to validate the build contract. We have our own credit process. So the lead on the role on the deal will be undertaking a credit paper that then goes to our credit committee, and it has to pass that credit committee, and that includes people like Greg that I mentioned before, and other key folk that have a long track record in credit. And ultimately, that's the decision point at which we'll push ahead with the loan. Once we've done all of those things, we'll then document that in the form of what we call a supplementary IM, and that's what we write for every single individual loan that we're doing. It's really designed for the investor to get a snapshot of who the borrower is, what the valuation is, what's the purpose of the funds, what's the project going to entail, the key metrics around term, pricing, loan to value ratio. And that's really the document that investors look at and make a decision about whether they're interested in pledging funds for. And ultimately, we'll do a book build. And once that's completed, we'll normally call for funds, probably 4 or 5 days before the due settlement date. In a nutshell, that's the process.
Absolutely. And it's very rigorous and very thorough. And I guess that's a great way to, at the end of the day, a good process tends to lead towards good results. And in your case there, you certainly have had a very, very strong track record in your space. Can you just touch upon that? And maybe also, do you have any thoughts about how your process has really helped your return profile? Because a lot of times in loans, let's face it, it's about the loans you don't write that really can make your record stand out.
Yeah, I think that's a really excellent point. And, often the saying is the best ones you do are the ones that you didn't do, right? And it is all about managing risk. So really over time, within that niche that I've described around that 2 to 10 million Eastern Seaboard development loan space, we've had really, really strong results. So, we're always returning the principal and the stated return back to the investors. Think of this asset class as being really in that sort of fixed income, fixed term space. That's what this is really all about. It has a fixed coupon. That's what we tell investors about at the outset, and that's really the value proposition for them. What happens over time is that you build up a portfolio of loans. You cycle out of those loans. You build up a really strong track record of having completed those loans. Over time, you also start to do the same business with the same borrowers, right? So you get familiar with the people that you're lending to. You may also be in a position where if you've initially undertaken a land loan, it moves into construction. Whilst it's a separate loan and a separate loan term, we'll do that construction loan. So really a nice example right now is we did a land loan for an industrial site, which was awaiting a permit. That permit's now been achieved. There's about 13 sort of light industrial units. They've all now been pre-sold, and we'll now undertake the construction phase. So by the time we look at that construction opportunity, we're already familiar with the borrower, we're familiar with the first term of the loan, and I think that's really helps us to build up a really strong overall picture. The other thing you talked about is how's that changed over time. So we've grown our team. We've added people in the credit space. We've added people in the loan origination space. We're 2 months away from launching our own loan management system, which will really do a number of extra things for us. One, it will allow us to just be more efficient around the loans that we're undertaking. Secondly, it's going to have a number of benefits for our investors. So where our loans today have distributions that we make because the borrower is paying interest along the way, we'll be able to make all of those monthly distributions to our investors. So the real sort of key message, Greg, is it's the investment in people, it's the investment in systems, and thirdly, it's really about capturing that universe of potential loans to look at, so that you're always comfortable about doing loans that you really want to do, rather than scratching around worrying about where the next deal is going to come from.
Absolutely, and you touched on how, oftentimes now your borrowers, you can, I guess, go through the whole journey with them from various stages. And maybe it's a good point to talk about just for the next 12 months, let's call it, what is your outlook as far as seeing supply of, of transactions coming through the tier one pipeline?
Yeah, Greg, there's two drivers at the moment that are really shaping the market right now. One is the way that the property market works in comparison to, say, the equity share market. In the equities market, we're used to things changing in a nanosecond. Prices adjust, it's very liquid. There's some really key characteristics. By contrast, the property market works in a very cyclical manner. So as you see things like prices rising, the response from the developers is to see that opportunity, but it might take them 18 months, 24 months to get to the point where the end product is on the market. So this whole sort of supply and demand takes time to react. So right now, what we've seen is, you go back to 12 months ago, think about what you were hearing in terms of predictions. People saying, oh, the property market's going to fall off a cliff, it's going to go down 30%. And, what's happened, in fact, is things have gone very much the other way. People are really keen on the property space. Look at residential, industrial. We're really seeing some strong growth in those sectors. So, number one, that the developers are responding to the pricing and market signals that you're seeing at the moment. Number two, the banks really started to pull out of development finance over 5 years ago. And part of that is structural and part of it is cyclical, i.e., cyclical means that the banks will start to come back into this space a bit. A lot of it was driven by regulatory change and their exposure to the property portfolio. From a cyclical point of view, the market, like our business and us as a non-bank lender, was really able to move into that space because we had all the skills, systems, funds management capabilities behind us to be able to fulfill this market space. And what's happened is, over time, the delineation between what a bank can do and what we can do has really, really narrowed down. So you go back 12 months ago and you'd say, well, I'll always go to the bank because I can get a cheaper rate there. But the sort of factors that have made non-banks competitive are numerous. One is a lot more flexible and a lot more responsive in terms of their ability to execute quickly. So we're talking a couple of weeks versus a couple of months. We will be in a position where we look at a loan on a standalone basis and say, what's the appropriate loan to value ratio? So let's just say we say it's 60%. So on a $10 million valuation, we're lending $6 million. The bank might be at 40, 45, 50%. So from a borrower's point of view, the ability to access more capital through the senior finance from a non-bank lender is a really attractive proposition. Equally, when we look at where a project is going to end up, and it's a construction loan, for example, if we like the price point and the product, we are happy to lend to that borrower with low or no pre-sales, simply because we know that there's liquidity in the market for that product at the end of the day. We're not so worried about seeing a lot of pre-sales, whereas the banks are typically focused on getting a very high proportion of their debt covered by pre-sales. And I think the final point to make is that price differential is actually coming down over time. So where maybe even 6 months ago, there might be daylight between the price of the banks and the non-bank lenders, that's really come in over the last 3 to 6 months, to the point that when you weigh up all the factors between a bank and a non-bank, the non-banks are here to stay because that value proposition is so strong now.
Absolutely, Chris. And I think that, we like to keep these interviews tight, but I think you've just given a really, really, really strong overview of the structural shift in Australian non-bank lending. And as a barometer, I know that it's certainly in the Northern Hemisphere, it's not unusual to see markets where 40% of loans are written by non-bank lenders. So, there's really a enormous amount of upside. Chris, do you have any closing remarks for the audience?
Yeah, look, your point about where we are in that mix compared to other markets, it's really, really telling. So if you go to the US, you go to Europe, the non-bank sectors are much more prevalent. So we see a really good upside in this space. I think as an asset class for investors, when you're looking at an area of fixed income, you're looking at yield, and you want an appropriate risk return proposition, I think consider non-bank lending as being part of that mix. We think there's a pretty strong trade-off there. We think it's got a strong future, and also, it's really about that cascading view of the world. You look at the asset class, you've got to look at the asset manager, and then you've got to look at the deal. And so we're really focused on, if you're interested in this space, then start to understand a bit more about a business like ours as an asset manager, and then you can pick and choose the deals that you want. But 99% of everything that we do is consistent across all of those deals, and that's part of our methodology. Great.
Thanks, Chris. I appreciate it, summing it up, and definitely stay in touch.
Will do. Thanks, Greg. Great to talk to you today.
You too. Bye-bye.
Bye.